Okay, everybody, great. That sounds good. You should be able to see my disclosures. Let's just go through them very quickly. This presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The discussions of a particular market or product shouldn't be considered as construed as an offer to sell or a solicitation of an offer to buy in any financial market whatsoever. This webinar has been provided without regard to specific investment objectives, financial situation, and needs of any particular recipient. And we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leveraged products may involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the U.S. Commodities Exchange Act, and contracts of difference, or CFDs, they're not available to U.S. residents due to regulatory reasons. Okay, everyone, let's get going. So with me, I pull up my other charts, and then we can get going. Okay, so a few things to start with. Let me just pull this down. As you can see, Eurostock, pull up a chart there. This is the theme of the game. This is the name of the game, really. We've had the Russian situation with Ukraine has definitely calmed down massively. We just had Putin on the headlines. That's why we can account for this spike here. And that's why I was a little bit late joining. I just wanted to make sure I covered that. But basically, he's really backpedaling. It looks like the situation with Ukraine has stabilised. Even though he's still trying to talk quite tough, he's definitely taken the edge off. So it really looks like there's not going to be a crisis in Ukraine necessarily in the very short term. That doesn't mean that problems have gone away. But tensions have certainly eased, and that is helping stocks to recover. And I'll just go to show you a little bit more about that in a much longer term chart. That's Friday. That's where we closed the week there above kind of 3,150. We then dipped all the way down to kind of 3,053. So a really sharp drop there compared to, how tight ranges have been of late. And now we're recovering again. We're at about 3,100 or thereabouts. And making fresh highs of the day on the back of these Putin comments. So it's certainly worth kind of watching for there. Again, as I said, I'm just about to put out a note on it really. But it's not like, unless you've got a crystal ball and we're going to preempt what Putin is going to do, then there is potential, this may be a dead cat bounce. We don't know. The one thing I would point out, obviously, is that we're not back at these highs here yet. So the markets are in recovery mode. But they're not there yet. So someone's just asked me what you're looking at. That's Eurostock, so the European index, stock index, top 50 European stocks. It's an index there. So let's put that to one side, because obviously in this environment, when we're in recovery mode and we're still very much driven by headline risk, and that's always a dangerous place to be in the market. We've got stocks rallying, the yen is falling, gold is falling. Those typical safe havens are coming under a bit of pressure. And this is dollar yen. So dollar yen, as you can see, this is an hourly chart, had a nice recovery. But I would point out we're not back at the highs that we've been at in the last 2 days. And the yen is still stronger against the dollar since the start of this week. So yes, we're in recovery mode, but we are getting stuck just a little bit around about that 101.90 level. So there's two reasons for that. Some short-term momentum indicators like MACD suggest that we're overbought in the short term. That's perfectly normal. But then there's something else as well. Sorry guys, let me just get rid of this. Don't need that. There is something else as well. This also coincides with the 100-day moving average, which comes in at 101.92. Oh, sorry, 101.92. My apologies. So hence why, we're just kind of stuck. And I think this chart, I can just expand that. This one really kind of goes to show where we are with dollar yen at the moment. And for those of you who love trading breakouts, then you'll know that not even threat of war could trigger a breakout in this cross. 101.20 attracted a lot of buying interest. Obviously, if we do fall below there, if there is an escalation of tensions, that could be a bit of a mess that could get us down to this kind of 100 level and the 200-day moving average here. But as you can see, for now, we're still very much trading in a range with 102.80 on the downside, or on the upside, 101.20 on the downside, just protecting us in the short term. So we're not really going anywhere fast, which is very annoying, I'm sure, to some of you. But equally, we are we are trying to, the markets are in recovery mode, that's for sure. I thought there was something interesting yesterday about what was going on in the FX spectrum, basically during this period of risk aversion. So what we saw, let me just bring up my new chart, my Aussie chart. So this is the Aussie dollar. In fact, I'll bring it up on a Bloomberg chart because it can sometimes be easier to see. This is my Bloomberg chart. As you can see here, this is an Aussie dollar, so it's the Aussie dollar versus the US dollar. And even though we've had some spiky moves in the cross, overall we're higher. Now, we did have an RBA meeting today. That could be one of the reasons. The RBA came out and they said, they stuck to their guns. They didn't say anything new at all. Stuck to their guns. They're going to stick to their kind of more neutral tone. They've dropped their dovish tone. That's helping the Aussie. So the Aussie, weirdly, didn't come under that much pressure, even though we did see risk off in the market. So, for example, we saw the yen do very well, but we didn't see the Aussie do very well, which is kind of an interesting thing because, the FX market, a traditional risk haven, risk off, FX market is when safe havens rally and the risky currencies like the Aussie fall. That didn't happen yesterday, and that could have something to do with this, which is oil. Let's take a look at Brent. I'm just looking at Brent because we're in UK hours. The US hasn't come in yet. As you can see, Brent yesterday rallied very, very sharply. Went from kind of a nice 109 all the way above to 111, and it's since retreated from there a little bit today as tensions have calmed. But I think that's an interesting thing because we didn't just see Brent rally. We saw wheat, for example. Wheat rose to its highest level in 2014 because Ukraine is a massive wheat producer. We saw the overall kind of commodity sphere do quite well because of how important Russia is as a commodity producer. And that is what's helping as well keep these commodity block of currencies or limiting their suffering, if you like. So that the commodity block of currencies didn't suffer as much as one could expect during this period of the Russian-Ukrainian crisis in recent days. So as I said, one of the explanations for this is actually what's gone on in the commodity sphere. And since rising commodity prices can be good news for these currencies, don't necessarily expect, guys, a clean split between safe havens and risky effects if we see tensions flare up once again. I guess that's the main message to take away from here is that we could, the Aussie could be a weird winner if we see tensions flare up again because that could be good for commodity prices and could be good for their terms of trade down the line. Because obviously the Aussie is a commodity producer as well. Likewise, it could limit CAD downside. CAD is also an oil producer. It's come under a bit of pressure recently from the US catching up as an oil producer. But obviously, if there are concerns about Russian energy exports, then people will turn. Then Europe, for example, will turn to Canada maybe to fill up that gap. So hence why we've seen just some weird goings on in the FX market. I know some of you may have noticed that, some of you may not have. But that's one explanation for what's gone on. So there's not necessarily that clear risk on, risk off split. So as you can see here with Aussie, we're still somewhere away from this 100-day moving average, which comes in 1956. So that's kind of the level on the upside that we're looking at. Now, Pan, you're interested in CAD. I'll happily take a look at CAD right now. We like CAD here. Range bound, basically, which has been quite interesting. As you can see yesterday, it was just really choppy. Again, that 112.30 is a key fib level. That is supporting the upside for us. And we have been kind of moderating really since then, alongside other crosses actually. So, there is certainly the potential for further upside. The trend still remains bullish, as you can see, but we are just locked into a little bit of a holding pattern, of a consolidation pattern here. The MACD though is above its zero line, so that does suggest that momentum is to the upside, that we've got a bit of a bullish trend in the longer term, and we could see some further upside there. But as I said, in terms of the upside, where we could go next, 112.36, that's a 50% retracement of the 2009 to 2011 bear trade. Above there, you're kind of looking at around about the 114 level. So they're the levels that we need to get above. So, that 112.36 is a massive level of resistance. And I don't think, as we lead up to some key meetings, this week, and probably topping it all off for this pair is going to be the non-farm payrolls report, that this is going to be necessarily that we're necessarily going to clear that 112.36 level. I think the market's going to be a bit nervous waiting until we get the non-farm payrolls report later this week. Okay, well, I'm glad that you like that into that point on the CAD pan, even though I suppose my technical outlook for dollar CAD is slightly contradictory to that. But I think, as I said, if there is a crisis in the Ukraine, don't necessarily think that would be negative or purely negative for the commodity block of currencies. That's kind of the thing that I'm just telling you to watch out for, because it can be quite a bad trap to get into, think that previous relationships will hold going forward, when we know that's just not the way markets work, especially when we've got different type of geopolitical crisis. It's not like the political crisis we've seen recently, which have mainly been in the Middle East. This is different. This is Russia. This is closer to Europe. That's kind of a bigger concern. The other thing I did want to point out was that Russia exports 30%. So 30% of Europe's energy needs come from Russia. Primarily in the form of gas. And where does that have to travel through? It has to travel through Ukraine. So there's a big problem. Maybe deflation and the ECB is not going to be such a concern if there is a problem. Not that that's the type of inflation that the ECB wants. But anyway, I thought it was an interesting point when someone mentioned it to me yesterday. So I thought I'd share that with you. But looking at the euro, as you can see here, this is euro on a daily chart. So we're kind of not doing fabulously well. This is a daily chart. Let's just take a look at the hourly. Our recovery has been tepid for sure. We fell to a low of 137.20, but there were some buyers up there. But we're still so far away from that 138 level that it just looks like, the fact that we couldn't get above 138 last week, or stay above there, or get a weekly close above there, is quite negative. Even though, the driver was some of that better economic data. Yesterday, for example, we saw better economic data out of the Eurozone. But the markets ignored that, and Ukraine was the main thing basically driving markets. Let me take a quick look at my Bloomberg chart. This is an Ichimoku cloud. I know some of you guys have joined me for many years on this webinar. And you know that I quite like the old Ichimoku. I find them quite simple to read. That's why I like them. So as you can see here, still in technical uptrend. We're above the cloud, right? But the cloud has got really, really narrow. And that suggests that we're maybe losing some momentum, that we're not necessarily going to see this big breakout. Now that's very normal to happen around these big levels. So 138, for example, massive level. We know that. 138.30 is also a fib retracement level. And it's also a trend line going all the way back to 2008. Now, I may have said this to you last Tuesday. I can't remember. But anyway, the point to note is that, at 138, around about 138, some nervousness is hitting in. That's no wonder. We are waiting for the ECB meeting. Now, look out for our research this week, guys, because later on this afternoon, I'll be posting our ECB preview. But I guess what I think is the most important thing to point out from here is that we've got is that basically, euro just it's not looking particularly strong, and it's hard to know, what is driving that. Is it fears about Ukraine, residual fears about Ukraine, because Europe is so reliant on energy from that country, from Russia? Is it problems or is it the market being a bit hesitant around the ECB? Now, the market is not expecting any change in the ECB this week, but we do get those ECB staff forecasts that go out all the way to 2016. If we continue to see weak inflation out to 2016, then we could see, that could weigh on the euro quite a lot. The other thing, obviously, is that these highs here, we could see Mario Draghi start to talk down the currency. Remember, a weaker currency could actually spare a bit of inflation into the currency block. And we also heard from Draghi yesterday, and he sounded a bit of a dovish tone, really, which has also maybe got the market a little bit nervous about how the ECB will react. So there's a lot of fundamental and technical issues hitting the euro right now. So follow our research, follow us on Twitter, and we'll help you navigate through that, because that's going to be quite important what's going on. Now, I'm also going to show you cable, because cable's been kind of a bit like the Aussie, really. It just didn't have as much of a downside as you might have expected. in the last, or yesterday, for example. We got down to that 166.40 level, but that attracted a lot of buying interest. It was almost as if the market was saying, that's just a dark cloud that's passing. Overall, the day is nice and bright, and we're not worried about what's going on. 167.55, that's been, that was the high from last week. 167.69 was the high from Friday, sorry. That is thought in the upside, so we don't look necessarily like we're going to make a kind of another stab at it. It's certainly worth watching out for some US and New York ISM data that's coming out at 2:45 our time today. But really, the economic data, the real juicy stuff for the pound will come out tomorrow and on Thursday when we get that Bank of England meeting. Just to give you a quick update, we don't expect anything from the Bank of England this week. We think it'll be another one of those boring statementless meetings. What we'll see instead is, or what we could see instead maybe is the PMI, sorry, the service sector PMI is going to be absolutely critical. It always is. It's worth watching out for. That will be released later this week. Let me get you our exact forecast for it. Just bear with me, guys. So we get services PMI tomorrow, 9:30, and the market is expecting 58, which is a notch, slightly weaker than the 58.3 from January, but it's still a respectable number. So that will be interesting. Any upside surprise there could really boost the pound back to that 167.69 level. But really, you know, if the Bank of England isn't going to do anything, the longer term outlook for this pair is going to be very much dependent, in our view, on what comes out of the non-farm payrolls on Friday. As you can see here, we're still very much in a consolidation in a holding pattern. Good support there at 165.80, which is the low from 24th of Feb. Whereas on the upside, we're still looking at that 168.23, which is the high from the 17th of February. So we are, it's going to take a big push to get us above that 168 level. We've been hovering around it for so long that, you know, it just really does suggest that the market is unwilling to turn cable lower, but it's just taking profit, and it's become a very frustrating trade, I would argue. Okay, now talk about frustrating trades. I'm going to look at the S&P 500. The market does expect this to move higher again. Obviously, we recoiled from those Friday all-time highs at 1867. 1822 is good support. That's the pink line on this chart, the 50-day moving average. But there's a good chance that we may go. We're currently trading at 1845. So the pullback was very small yesterday. Again, just reiterating that view that I shared earlier about how, you know, the market saw what was going on in Russia and the Ukraine as more of a passing cloud rather than, you know, a big storm that was here to stay. The market called Putin's bluff, really, and they were right to do so. So we could see another recovery and get back above those 1867 levels. So even though the last 2 days have looked fairly weak for stocks, largely because, you know, there was so much geopolitical uncertainty. Geopolitical events are by their nature very complicated, so they're hard to predict. It's very hard to predict how Putin will move going forward. But I think for now the markets were very much just in wait and see mode, and because obviously we've seen, you know, tensions calm or stabilize in the last 24 hours, or last kind of 12 hours, I should say. We could see a bit of a recovery in this, maybe retest of fresh highs. So certainly worth pointing out for there. I do think, though, that it's going to be harder to extend the upside. And again, as I said, like, you know, the economic data doesn't seem like it's there right now. Instead, what we're seeing is, you know, a lot of economic data misses out of the US. Now, partly that's down to weather. And that's also, you know, down to there's a concern about how strong the recovery actually is. So that's certainly worth worth noting with stocks. If you're thinking about longs at this level, will the economic data really justify going long at a record high in the S&P 500? We may have to wait for later on this week to really get a sense of whether or not that will be justified. Because obviously those non-farm payrolls for February will be very important, but people are already starting to temper any expectations that they'll give us a real good view of what's going on, largely because of bad weather in February, which could disrupt payroll. So it'll be an interesting thing to watch out for sure. Now, I've got about 5 minutes left, guys. Obviously, I've kind of whittled on. Does anyone have any questions? Oh, I'll talk about gold. Let me talk about gold here, and then I'll take a question at the end. So this is gold, as you can see. It's been a bit choppy, but it still looks good. It's still above the 200-day moving average. It's currently trading at 13.38. It was trading at a high of 13.54 yesterday, and then it dropped. So it's been dropping on these good news headlines coming out of Ukraine. But as I said, it still looks like it's in this uptrend. Again, we are, with gold, I think, watch out is what gold does is considered an inflation hedge. So it's important to, there is a fundamental risk for gold coming out of that ECB meeting. If the 2016 forecast is still pointing to weak inflation in the currency bloc in 2016, that could really weigh on gold a little bit. Now, I'm not saying it's going to be a key driver, and as I said, that unfortunately gold's not that simple. You can't just say it's down to one thing. It's down to there are multiple drivers of the gold price. But that is a fundamental risk for gold, so do watch out for that. But as I said, some very good support here at 1300, which is that 200-day moving average. And then there's a cluster of support, 1267. So 2014 has been good news for the gold bugs. It's been nice, kind of steady uptrend. We've stumbled a little bit on the back of what's going on in the Ukraine, but it still looks good to me. But as I said, just watch out for that, because there is that risk that we may see, there is that risk from the ECB meeting this week. Anyone got a question for me? We've got about 2 or 3 minutes left. Okay, guys. Well, listen, in the absence of another question, I'm going to leave it there, actually, because I think that we've kind of discussed so much. We've gone through an awful lot. I know it's a lot to digest. I know some of you will be desperate to get back to your trading platforms because there is a bit of volatility going on at the moment as we digest yet again another round of a headline risk coming out of Russia. So I'm going to leave it there, guys. Thank you so much for joining, as always. Please join me next week, and thank you again. Bye-bye, everyone.